the 29th of October 2025. Right. Today I'll talk about inflation at 3%, implications for Fed policy and rate cuts. Now, the September CPI report released later than usual due to temporary government shutdown revealed that both headline and core inflations were running at 3% year over year. Now, this definitely marks a significant milestone in the battle against price increases. Just a year or two ago, inflation was running at multi-decade highs, forcing the Fed to crank up interest rates aggressively. Now, seeing headline inflation and the more stable core inflation both down to 3% indicates that the surge in prices have been firmly tempered. Now, for the Fed, whose explicit goal is to keep inflation around 2% over time, a 3% reading is tantalizingly close to success. It suggests that the series of interest rate hikes and other measures taken since 2022 are finally bearing fruit in slowing the economy price pressures. Now, importantly, core inflation dropping to 3% implies that underlying inflation, strip off volatile food and energy costs, has substantially cooled not just the transient swings in gas or food prices. Now, though some may argue 3% is still above the Fed's 2% target, this 3% range is a far cry from the 8 to 9% inflation surge in mid-2022. In fact, inflation has cooled earlier in 2025, where it dipped to about 2.3% in April before inching back up in late summer. Now, in practical terms, the economy is much closer to price stability than it has been in recent memory, even if it's not quite mission accomplished yet for the Fed. Now, in fact, the inflation has eased without a severe recession so far. It's a welcome development for the Fed. So next, let's look into why the Fed might cut rates despite the 3% inflation. Now, several factors explain why talk of rate cuts is back on the table, even though inflation at 3% is still above target. In essence, the Fed believes the recent inflation overshoot is temporary, while signs of economic softening, especially in the jobs market, are becoming a bigger concern. Here are the key reasons. Now, first of all is transitory inflation pressure. The Fed officials have suggested that one-off factors are inflating prices and should fade away. For example, import tariffs have driven up the cost of many goods recently, but tariffs cause a one-time jump in prices rather than ongoing inflation. Now, if you exclude these transient boosts like tariffs and the late summer gas price jumps, underlying inflation may already be near the Fed's goal. This gives policymakers confidence that inflation will ease back down on its own. The Fed can thus justify lowering rates by arguing 3% inflation is largely transitory. Okay. Next is a cooling labor market. There are growing signs of weakness in the jobs market, and the Fed is increasingly worried about this. Jobs growth has slowed dramatically, where private sector's hiring has nearly stalled and layoffs have ticked up in some sectors. Fed Chair Jerome Powell and his colleagues have signaled they are now more concerned about employment than slight overshooting of inflation. As evidence of this shift, the Fed's implemented what Powell called a risk management cut in September, its first rate cut since 2024, specifically to address a softening labor market, even though inflation was still above target. Now, the bottom line is this. The Fed believes inflation at 3% isn't a crisis, especially if it's driven by temporary factors like energy costs or tariffs that will not persist. So, Fed officials are signaling that a small rate cut can be done safely to help the economy without letting inflation get out of control. Okay? Now, for the rate cut expectations, as of the latest update, there is about a 97% probability that the Fed cuts its benchmark interest rate by 25 basis points on October 29, 2025, which is today, versus only a 3% chance that they will leave rates unchanged. Economists are not only confident about an October cut, but also lean heavily towards another cut in December. the CME futures indicate a 94+% probability that by December meeting, the Fed will have cut another 25 basis points. Now, the market isn't expecting anything more aggressive than 2 small cuts for now. Looking ahead for the rate cuts in 2026, the question becomes how fast the Fed might lower interest rates. Current indications suggest the Fed will proceed cautiously, but markets and economists do see additional rate reductions in 2026. In the Fed's own September dot plot, most Fed officials pencil in a series of cuts over the next year or two. By some estimates, the federal fund rate could be down to around 3% by the end of 2026. So now the big question is this. A lot of people are saying, they're cutting rates, then QE is going to come back. So is QE, aka money printing, coming back? Beyond just interest rates, the Fed has another powerful tool. It's called the balance sheet. Now, over the past few years, the Fed has been engaged in quantitative tightening, or QT, which is essentially the opposite of money printing. It is taking money out of the market. Okay, so in QT, the Fed reduces its bond holdings by letting bonds mature off its portfolio. This drains liquidity from the financial system. QT was part of an effort to fight inflation, undoing the massive quantitative easing, or QE, stimulus that Fed deployed during the pandemic. Since starting QT in June 2022, the Fed's balance sheet has shrunk from nearly 9 trillion to about 6.6 trillion as of October 2025. Now, major Wall Street banks like JP Morgan Chase, Bank of America now predict the Fed will hold QT in the coming weeks or months rather than late 2025 as previously thought. Why the sudden shift? One big reason is that liquidity in financial markets have gotten tighter, pushing short-term borrowing costs higher in markets like the repo, or better called repurchase market. Now, Fed Chair Powell himself acknowledged recently that the end of QT is nearing due to signs of stress in funding markets. So the Fed doesn't want a repeat of 2019 episode where it had to interfere with emergency cash injections because it has drained too many reserves. Now, the end of QT can be described as the Fed's injecting liquidity back into the system, since private markets no longer has to absorb an ever-growing supply of bonds. Now, to be clear, the Fed is not doing QE now, and any such move would likely come only if the economy needs serious stimulus, for example, in a recession or a financial crisis scenario. However, the fact that QT is expected to end by early 2026 at the latest sets the stage for a potential shift towards neutrality and eventually easing. Now, JP Morgan have suggested that once the Fed stops QT, it could even begin temporary open market operations, which is essentially short-term bond purchases to ease short-term liquidity stress in markets around year-end. Those would be tactical, small-scale interventions. Now, only if the economic slowdown deepens or the Fed cuts rates substantially, then the next logical step could be to resume asset purchases in 2026 to provide additional support. So as a conclusion, the combination of Fed cutting rates by 50 basis points in 2025, that means one in October, one in December, 25 each, and 100 basis points in 2026, ending QT and reducing net bond supply, the private sector must absorb combo X as an oxygen release on assets like equities, credit, and crypto tend to breathe. Okay, so if they cut this is good for equities, it's good for credit, it's good for crypto. That mix typically supports higher equity multiples, tighter credit spreads, better debt, and stronger risk appetite across equities, credit, emerging markets, commodities, and crypto. Now, the lift is greatest as this inflation stays intact and earnings holds up. Okay, the main risk is that the Fed is cutting because economy is getting weak, or investors think inflation will heat up again. Either way, borrowing costs could rise and take away much of the market boosts. Still, If the economy stays calm and inflation keeps easing, the overall tilt is towards risk on. Okay, so hopefully that is able to give you a better understanding of what's going to happen, and stay tuned because the Fed meeting is early, early tomorrow morning. With that, that's the report for today.